I'll be talking about 6 of my favorite growth ETFs that I like to invest in for long-term growth and retirement. These ETFs were carefully selected to strike the perfect balance between maximum growth and returns, diversified portfolio, and low fees. These ETFs will help you build strong foundation on your wealth building journey. I will start with 2 broad growth ETFs, move on to 2 technology ETFs, then close out with 1 emerging market or international ETF and 1 target date fund. I would love for you to comment down below which are your favorite growth ETFs. Even if it's not one that I will be talking about today, I would still love to see what you all are investing in and care about. So maybe I could review them as well. Jumping into the first ETF, which is Invesco Nasdaq 100 ETF QQQM. To give you a little more background about this ETF, it includes securities of 100 of the largest domestic and international non-financial companies listed on Nasdaq. We can see this by looking at the sector allocation. Most of the fund is invested in the technology sector, followed by consumer discretionary and healthcare. The top holdings are Apple, Nvidia, Microsoft, Amazon, Broadcom, Meta, and Costco. As of February 2025, this ETF is trading at $215, which is slightly cheaper than a similar ETF from Invesco QQQ. Now to the performance of the ETF, which is a critical factor that you need to consider when choosing an ETF. This ETF had a 26% return in the past year, and the index has similar solid returns over 3-year, 5-year, and 10-year period. These returns are well above inflation and any rate you could possibly get from a high interest savings account. Another important thing to look into is the management fee, which is what you pay the fund manager for their services. The goal is to keep the management fee as low as possible, as this adds up over time and could potentially reduce your returns. Management fee is at 0.15%, which is relatively low as compared to mutual funds that could charge anywhere between 1 to 2%. Moving on, our next ETF is Schwab US Large Cap Growth ETF. SCHG. For SCHG, this tracks the Dow Jones US Large Cap Growth Total Stock Market Index, which includes a broader range of sectors than QQQM. While tech is still significant, SCHG offers more diversification with communication services, healthcare, and financial sector. Top holdings also include Apple, Microsoft, Nvidia. Expense ratio for this ETF is 0.04%, making it a cost-effective option for investment. Now to the performance. 1-year return for this ETF is at 34%, and we can see an average of 17 to 18% over the past 10 years as well. This ETF is priced at $28, once again making it a low-cost option. By now, you can see there are so many similarities between QQQM and SCHG. However, QQQM is very tech-heavy and less diversified as compared to SCHG, while SCHG has a lower expense ratio and more cost-effective overall. Personally, I am leaning more towards SCHG, so if I were to choose either or both, I would go with SCHG. But if you want to invest in both, you can simply just split your money 50-50 and get the best of both worlds. If you're interested in growth, particularly from the technology sector, I have another ETF for you. Vanguard Information Technology ETF, VGT. So compared to the previous 2 ETFs, QQQM and SCHD, that primarily focuses on technology but has other holdings as well, VGT focuses solely on the information technology sector. Of course, there is potential for higher growth, but higher growth comes higher risk and higher volatility as well. Price point for this ETF is around the $620 mark, which is a little on the higher side. With respect to the portfolio composition, Apple, Nvidia, Microsoft, Broadcom, Salesforce, Oracle, Cisco, Accenture, ServiceNow, and IBM make up the top 10 holdings. Now to the performance. This ETF has 1-year return of 25%, 3-year return of 14%, and 5-year return of 10%. Again, these are solid returns, and I wouldn't expect anything less since the tech sector has been booming for quite some time now. Expense ratio for this ETF is 0.09%. I mean, that's a decent price to pay for these returns. The next ETF on my list is Fidelity MSCI Information Technology ETF, FTEC. If you like VGT and you want same technology sector exposure at a lower price point, then this ETF is for you. This is currently priced at $184, much cheaper than the $620 for VGT. Starting with what sort of holdings this ETF has. Let's take a look at the composition. Top 10 companies are Apple, Nvidia, Microsoft, Broadcom, Salesforce, Oracle, Cisco, IBM, Accenture, and ServiceNow. Mostly giant and large companies, which fall into the large growth bucket. In terms of geographical footprints, 99% of these countries are in North America. Now to the returns for this ETF: 25% in the last 1 year, 14% in the past 3 years, 20% in the past 5 years, and 21% in the last 10 years. When it comes to expense ratio, this is at 0.084%, which is slightly lower than VGT. Overall, there's a lot of overlap between VGT and FTSE. So my advice would be for you to choose either of the two. All ETFs mentioned so far are mainly focused on the US market. But to add some geographical diversification to your portfolio, I have Vanguard FTSE All World ex-US ETF, VEU. This focuses on developed and emerging markets around the world outside of the US. Looking at the portfolio composition over here, the fund has 3,831 stocks, with majority being Europe, 27% from emerging markets, 26% Pacific, a little bit of Middle East, and 7% of the rest of North America. Price is at the lower end of $59 and expense ratio of 0.04%. That's about the lowest we have seen so far in today's video. Now to the performance. Year to date is 3%, 1 year is 11%, 3 years is 3%, 5 years is 6%, and 10 years is 5%. As you can already tell, the performance is lower than the average returns for the other ETFs in today's video. But despite that, this is a good ETF to have, as it provides some sort of buffer for when the US market is down. Other parts of the world can always make up for it. This last one is for those who don't want to worry about all these ETFs and just want to focus on one fund. There is something called a target date retirement fund. In simple terms, this investment fund is designed to automatically adjust its mix of stocks, bonds, and other investments based on your planned retirement date. For example, if you want to retire in 2050, which is 25 years from now, you might invest in a 2050 target date fund. As you get closer to your retirement, the fund gradually becomes more conservative and less risky, shifting to safer investments to protect your savings. It's like having a hands-off way to invest for retirement without needing to constantly manage your portfolio. There is a wide selection to choose from based on when you want to retire. If I choose the 2035, you will see this is composed of US total stock market fund, some international exposure, and less risky bonds. If I compare this composition to the 2070 fund, this is leaning more towards stocks and minimal bonds. Like I explained, the farther the timeline, the more risk that can be taken. Price for the 2035 fund as of today is $24 with an expense ratio of 0.08%. In terms of performance, this has a 1-year return of 14%, 3-year return of 5%, 5-year return of 7%, and 10-year return of 7%. Target date funds are an easy way to invest for retirement, and you don't have to buy from Vanguard. You can check out iShares and Fidelity as well. They usually have similar products. I didn't mention the good old S&P 500 ETF in this video because I already have a video dedicated to my favorite S&P 500 ETFs. I will leave the link to that video in the description box. Every portfolio needs a S&P 500 ETF, so make sure to check it out. That pretty much covers the top growth ETF. My name is Ayolua. If you're stopping by this channel for the first time, I am a qualified accountant and a personal finance educator. I talk about various ways of making, managing, and multiplying your money on this channel. Please subscribe to the channel and like this video so the algorithm pushes this video to other great minds like yourself. See you in the next one.